Hi, welcome back to Joe Blogs. This video is the next in a series looking at the financial implications of Russia's invasion of Ukraine on the global economy. And in today's episode, I've got some really interesting data to share with you on Russian oil exports and the forecasts for Russian oil. So we've now got the data in for September, and this is in millions of barrels per day. So this is not influenced by what's happening to prices. And I'm sure you'd be really interested to see that exports are already starting to fall from Russia's side of things. And this is before the EU ban actually kicks in. So we'll have a look at that data. We'll then have a look at the revised forecast that the Russian ministry have released for oil exports over the next 3 years. And they've downgraded those forecasts. So everything is starting to take shape in terms of the impact of the financial sanctions. It's starting to hurt Russia's oil business. We'll then have a look at how important oil is with regards to Russia's GDP and its total amount of exports. We'll then have a look at what's going on with regards to oil prices, because we've got a downward trend at the moment. And I'll share with you an IEA report which gives a forecast of supply and demand in the global oil market over the next 18 months or so. And there's some really interesting data coming out from that, which will have another big impact on the Russian economy. I'll then talk about the forthcoming EU ban and the proposed oil price cap. And then finally today I'll wrap up with my summary as to what I think is likely to happen over the next 3 to 6 months for Russian oil, what the impact of that will be on the Russian economy, and what the impact of all of this will be on the global economy. But before we get started, if I could ask you to give me a thumbs up at some point during this video if you're enjoying the content. Please subscribe if you haven't done so already. Don't forget, I always include chapters in these videos, so if you don't have time to watch the whole thing, you can skip over sections. And if you'd like to support the channel, please have a look below where you'll find links to YouTube, super thanks and membership, as well as Buy Me a Coffee, Patreon and Amazon shopping links. And once again, I'd like to say thank you so much to everybody that has supported the channel. I really appreciate it. Now, as you'll know if you follow the channel, Russia have stopped publishing most of their data, so it's really difficult to get detailed information. But the International Energy Agency has published their statistics showing the level of Russian exports for September, and surprisingly, there's been a fall in the month. Russian oil exports dropped by nearly 4% in September as sales to Europe fell sharply ahead of EU sanctions that kick in at the end of the year, the International Energy Agency said. Russian oil exports fell by 230,000 barrels per day in September to 7.5 million barrels a day. Crude exports were down 260,000 barrels per day to 4.8 million from a recent peak of 5.5 million in April. However, this figure was offset slightly by an increase of 30,000 barrels per day in the export of diesel and gasoline. Shipments to the European Union fell by 390,000 barrels per day to 2.6 million. And the share of European sales in Russian total exports fell to 35% from 50% at the start of the year. Exports to India, which has ramped up purchases of discounted crude, remained stable at 1 million barrels per day in September. Loadings to China, the largest importer of Russian crude since June, were down 115,000 barrels per day. So these figures are surprising because the European Union ban doesn't actually take effect until the 5th of December. And whilst a lot of the countries in Europe have stated their intention that they want to stop buying Russian crude, they haven't actually done that yet. So the slowdown in the export of Russian oil wasn't actually expected to take place until the end of 2022. And the reduction of 230,000 barrels in the month, if we take a ballpark price of $100 per barrel to keep things simple, that equates to a loss of revenue for Russia of $23 million per day. So that's obviously a concern from Russia's perspective. But I think what's a bigger concern here is the fact that the Indian exports hadn't actually increased in the month and the Chinese exports had actually decreased. So the whole narrative that we've been talking about since the start of the Ukraine war is that Russia is going to pivot and it will sell all of its oil directly to India and China, and that will replace all of the lost business from the West. But we're not actually seeing that. We were seeing it at the start of the conflict, and that's predominantly because Russia was offering huge discounts on those oil sales, around 30% discounts to both of those countries. Now, clearly Russia doesn't want to continue selling at a discount, so it's now trying to reduce the amount of that discount, and what we're seeing is that the appetite from India and China just isn't there. So the only way that they will continue buying large volumes will be if Russia continues to offer huge discounts. So that becomes a really vicious circle from Russia's perspective, that they can ship the volumes, but they won't get the revenue for it. And we're now starting to see cracks appearing in those relationships. And the big question is whether or not Russia will be able to ship those extra volumes, or whether they will just see their whole market crater. Russia's finance ministry has significantly cut expectations of taxable oil production for 2023, according to the draft budget for the next 3 years, in the expectation Western sanctions will mean an overall decline in output and refining volumes. The draft budget anticipates Russian oil and gas condensate output at 490 million tonnes in 2023, which equates to 9.84 million barrels per day, and represents a decline of around 8% compared with the 10.6 million barrels per day for 2022. However, it's interesting to know that Reuters analysis is forecasting that the fall could be even greater. The budget data show that oil refining and export volumes have been revised down to 8.2 million barrels per day in 2023 from the previous forecast of 10.15. which represents a reduction of over 19%. Of this, refining volumes were revised down by around 20%, and oil exports are down by 19.4%. So let's have a look at just how important oil is to Russia's economy. This graphic shows the breakdown of all Russian exports for 2021. And as you can see, oil equated to around 43% of all of the revenue that Russia was earning. And the total revenue that Russia earned was over $210 billion. And that figure really puts into perspective the projected fall of $73 billion that we've just talked about from the Russian forecasts. And if we then have a look at this chart, which shows the percentage contribution to Russian GDP provided by the oil and gas industry. And you can see that in the first quarter of 2022, oil and gas contributed almost 22% to total Russian GDP. And if we look back over the last 5 years, you can see that it's been consistently at around 20%. If we ignore the period in 2020, which was the COVID pandemic situation, oil and gas are by far the two largest contributors to Russian GDP. Now, as you've just seen from the statistics, in 2021, Russia earned over $200 billion from oil sales, and the gas sales were around about $40 billion. So oil is by far the biggest contributor to Russian GDP. So if we now factor in the 20% fall that the Russian ministry is forecasting for 2023 in oil exports and apply that to GDP, you have to believe that GDP is going to fall by roughly a similar figure, which doesn't really correlate to the forecast fall of 4 or 5% in the Russian economy that the Russian authorities have projected for 2022 and 2023. So once again, the words and pictures are not really matching here. We are seeing the largest, biggest income stream from Russia falling by 20%, but overall the economy is only going to fall by 4 or 5%. Now, where is Russia going to make up the difference from? We know that gas sales are actually looking worse for Russia than the oil sales, because the vast majority of Russia's gas goes by pipelines directly to Europe, and Europe has stipulated that it wants to stop buying all of that gas. The Nord Stream pipeline was blown up recently, so no gas is flowing through that pipeline anymore to Germany. Poland, Finland, Denmark, Bulgaria and the Netherlands have all had their supplies switched off, and most of the other countries have filled up all of their capacity to give themselves headroom through the whole winter period. So Russian gas sales are going off a cliff. They don't have enough LNG plants to be able to convert that gas into a liquefied form to be able to sell it to Asia or anywhere else that wants to buy it. So Russia are going to have to leave that gas in the ground. They're not going to be monetizing the vast majority of that energy source. So they're going to lose a fortune from gas. Oil is down 20%. A lot of their other exports have been sanctioned already. So those sanctions are already in place. So I'm struggling to see how Russia's going to make up the big falls in revenue from its major income sources and only see a 4% fall in its economy in 2022 and 2023. That doesn't seem realistic. And I think that's why Russia have stopped releasing their figures. Because if they were having to publish this data, we would be seeing month-on-month falls in that economy, and it would be significantly more than 4%. So these revised forecasts take into account what's going on right now and what the projections are for the future. But the big question mark really is what's going to happen when the European ban on Russian oil purchases kicks in on December the 5th. This graphic shows the total amount of crude oil exported by Russia to the EU. It's the line across the top of this graph. And you can see that at the start of 2022, Russia was selling 2.6 million barrels of oil per day to the European Union. Now that figure has started to come down as many of the countries have tried to buy from other countries. And you can see on this graphic that there's been an increase in purchases directly from the United States and Norway. But in August 2022, Russia was still the single largest supplier of oil to the EU and was selling around 1.7 million barrels per day. Now, as of December the 5th, all oil that's currently transported by ships will be banned for European purchases. So that means that the only oil that Russia will be exporting into Europe will be via the pipelines. So over the course of the next month or so, Russia needs to find a new buyer for those 1.7 million barrels per day. Now, as we just discussed earlier in the video, India is currently buying around 1 million barrels per day, and that figure has remained flat for the last month or so. During the early part of the conflict, China increased its amount of purchases up to about 2 million barrels, but that figure has gradually been reducing. So between the two of them, China and India are buying roughly 3 million barrels of oil per day from Russia. So in order to replace the lost sales from Europe with additional sales to China and India, those two countries will need to increase their purchases by almost 60%. Now that is a massive change in their purchasing arrangements. And as we've discussed before, the problem that Russia has is actually getting the oil from Russia to India, because it needs to put all of that oil onto ships. There aren't enough ships around at the moment because a lot of the supply chains are changing. So the fact that Europe is now buying a lot more oil directly from the USA is meaning that there's a lot more demand for shipping, because all of that oil also needs to be shipped. So a lot of the shipping companies are already working on those new transport routes. And one of the problems that Russia has is that it's facing a problem actually chartering enough ships to be able to move that oil. So even if India wanted to buy another 1.7 million barrels, how can Russia actually get it to them? Because firstly, it doesn't have enough ships itself. Secondly, the USA, Qatar, Saudi Arabia are all chartering these ships that are in existence. And thirdly, a lot of the insurance companies, which is absolutely essential when you're transporting oil, are from the West. And they've all applied sanctions against Russia. And this is all part of the oil price cap, which I'll come on to talk about in a moment. So Russia's facing a multitude of logistical problems in actually being able to sell that oil to India and China. There are a couple of pipelines that are in place that supply China, but those pipelines don't have sufficient capacity to be able to handle an additional million or 1.7 million barrels per day. So the European ban, which is now very close to coming into effect, is going to cause major problems for Russia and its oil exports and its economy. Now, an additional factor that Russia have not included in terms of their budgeting is the proposed oil price cap. And we are now close to that oil price cap being announced. So the G7 countries, which are the largest 7 economies in the world, so a big part of what I'm referring to as the West, who are applying the sanctions against Russia, they've been working on this concept of reducing the amount of income that Russia can earn for all of its oil exports. And the way that that's going to be affected is this oil price cap. And that will be put in place predominantly through the insurance and the shipping companies. So as we've just discussed about the logistical problems of Russia moving its oil to India, it needs to put that oil onto ships, and those ships need to be fully insured. Firstly, in case there's a problem at sea, so if that ship was to sink, then an insurance company would have to pay out on the recovery of that ship, and then all of the ecological and environmental damage that the oil would cause to those oceans, and then obviously repaying the owners of the ship and all of those associated costs. But in addition to the insurance of the ship itself, Insurance is also needed by a port to enable those ships to dock and unload safely. Because if there was a problem in the port, if it damaged the port or there was an explosion or a leak, then that port would obviously need to clean up and become operational in a rapid space of time. And so the insurance would need to cover all of those costs. So Indian ports will not allow Russian ships to dock unless they have all of the appropriate paperwork to show that they are fully insured and everything is safe and sound. And the problem that Russia is facing is that the vast majority, over 90% of all shipping insurance, is provided by companies from the West. So these are long-standing historical companies that are based in the UK and Norway and the USA, and it's going to be very difficult for Russia to be able to increase the volume of its exports to Asia without having any of those insurance companies on board. So the oil price cap has been designed so that the insurance for those ships is only eligible if the sale of the oil is agreed below a certain figure. Now, the figure is still in discussion, but as I mentioned in a previous video, it's been leaked that the figure being talked about right now is $63 per barrel. And when you equate that to the current market prices, it represents a significant discount. Now, $63 per barrel is above Russia's production prices. Now, there are no official figures released, but it's estimated that for Russia, a barrel of oil costs around $40 to produce. So $63 would give them a $23 profit. So it would enable the industry to carry on and make some profit. And more importantly, it would enable Russia to keep its production flows going. As I mentioned earlier in the video, it can be very problematic if you have to stop your flows. And I think that's an important factor because Russia have threatened to stop all of their exports if this oil price cap is enforced upon them. But realistically, they won't be able to do that because they don't have sufficient demand within the country. The population of Russia is around 145 million, so they can't use 10 million barrels of oil per day. It's impossible. And Russia doesn't have anywhere to store all of this oil. So if it hasn't got the export markets, the only other option is to stop its production. And if it does that, it could cause itself serious problems. So the oil price cap actually gives Russia an out. It enables them to keep their production going. And it also offers benefits to other countries because if you're India or China, the benefit that you're getting is that you're doing a deal with Russia at $63 rather than $70 or $80 or $90 in the open market. And it enables you to carry on trading with the West, so you don't run the risk of having secondary sanctions applied against you. Because if that happens and India and China lose all of their trade with the West, then that would be detrimental to their economies. So it's a win-win situation for India and China because they can buy cheap oil, large volumes, and they can carry on as normal. The only country that will lose out in this situation is Russia. They will see a drop in their revenues, but the flip side is they would still be able to keep their production going. So that's how the oil price cap is going to work. And Russia have not factored this into their equations at all. So if it does come into effect and it works, then Russia will need to reduce these forecasts even further because they're assuming at the moment that they'll hit certain volumes at market prices. If those prices are significantly less, then that's going to reduce their revenues further and have an even bigger impact on the economy. As we just talked about, oil equates to around 20% of GDP in Russia. So if the oil price cap is going to clip the amount of revenue, then that's going to push GDP down even further. I thought it was worth sharing with you forecasts for global demand and supply over the next 12 months that have been put together by the International Energy Agency. This graph shows global demand and supply for oil from Q1 2021 through to Q3 2023. The yellow line is demand, the blue line is supply, and the bar chart at the bottom show the international levels of stock. So you can see that in the 4 quarters of 2021, demand for oil outstripped supply, and as a direct result of that, we saw a reduction in global stocks as all of the producers used up all of their supplies. They released it into the market because demand was exceeding supply. In the first quarter of 2022, which included 1 month of the Ukraine war, demand still exceeded supply, but the differential narrowed, and once again we saw a reduction in the global stock of oil held. In the second quarter of this year, we saw a continued reduction in demand, and supply actually exceeded demand, and we saw an increase in global stocks. And the latest expectations are that the supply of oil is forecast to be greater than demand through to the second half of 2023. And the exact situation can be seen from this graph, which shows supply in blue and demand in red. So over the course of the next 6 to 9 months, it's expected that supply will outstrip demand. And as you'll know from very simple economics, when supply is greater than demand, that generally means that prices go down. And a fall in oil prices is exactly in line with what's been happening over the course of the last 4 months or so. And the price chart for oil over the last 12 months shows that from the peak of around $120 per barrel that we saw at the start of June, prices have come down significantly. Now, the reason that I wanted to share this data with you is that the current trend in oil prices, plus the expectations of what's going to happen over the next 6 to 9 months, show that there's going to be downward pressure on prices. And this really ties in with the global slowdown. When we see a reduction in GDP from countries, it generally means that there's less demand and therefore the price of oil will go down. And the reason I wanted to mention this is that the forecasts that have been put together by the Russian ministry don't really take into account a major push down in oil prices. And if we do see downward pressure on oil prices, then that will have a really big impact on the Russian economy. When oil prices crashed towards the end of the 1990s and got down to almost $10 per barrel, that caused the Russian economy to collapse, and they actually defaulted on their domestic debt at that time. So movements in the price of oil have a disproportionately high impact on economies who are dependent upon oil, and Russia is entirely dependent upon oil. So if, as expected, over the course of the next 12 months, we see oil prices going down and down, then that is going to mean more bad news for Russia's economy. So what's the summary and conclusion today? Well, I wanted to post this video because oil is fundamental to the success of Russia. If oil is doing well and Russia is exporting lots of oil, then its economy will be buoyant. If there are problems or if prices are going down, then that's going to impact on the Russian economy. And what we've seen today is that in September, there was a fall in Russian exports. And that was unexpected because the oil sanctions from the European Union are not actually in place yet. So this is starting to happen before we see the impact of everything feeding through. And the second issue that we saw today was that the Russian ministry have downgraded all of their expectations for 2023, 2024 and 2025. And this is a further downgrade on the previous set of numbers that they issued. So we're looking at a 20% cut compared to where they were previously. Now, 20% cut for a country like Russia is massive because oil is fundamental to their GDP. It equates to around 20% of that GDP. So a 20% fall in oil revenues is likely to have a proportionate impact on the Russian economy. Now, that doesn't tally with the figures that we're seeing coming out from Moscow, which are 4 or 5% fall for 2022 and 2023. So I'll leave you to make your own decisions on whether or not you think that's realistic. But when you look at the fundamentals of what's going on in the market right now, it all looks bad news for Russia because they're already forecasting a big fall in revenues. But that doesn't really take into account the impact of the sanctions that are coming through from the EU. And Russia needs to find a buyer for an additional 1.7 million barrels per day if it's going to keep its revenues flat. And that's going to be very challenging given all of the logistical problems of moving that quantity of oil to India or China. But in addition to that, they're now also facing the prospect of an oil price cap being applied by all of the countries in the world. And it's going to be very difficult for Russia to actually fight back against that if India and China say, well, we're not actually constructing this price cap, but we can't really avoid it because we will lose all of our other business. It's a really good excuse for both of those countries to sign up to it, and it would leave Russia in a very difficult position. But over and above all of that, we're now also forecasting that global demand is going to be less than supply. And when you have those situations, it always leads to a reduction in price. So there's a lot of factors pointing towards a big downturn in the Russian economy for 2022, 23, 24, possibly even 2025. So the forecast figures that we're seeing right now of a mild recession in Russia doesn't really stack up. It's likely that a lot of countries around the world could hit a recession of 4 or 5% falls in 2023 because the global economy is going into some form of downturn. And Russia is likely to fare much worse than many other countries because the success of the economy is directly linked to oil and gas. If we do have a global slowdown, the demand for all of those products will go down, so will the price. But also, we've got the sanctions against Russian products specifically. So Russia will do much worse than the rest of the world. And it's likely, in my view, that their economy will fall by double digits. And it could be a really big fall that we see in 2023. So hopefully that's shed a bit more light onto the situation for you and you found this video interesting, informative and thought-provoking. If you've liked what I've said, then please give me a thumbs up and don't forget to subscribe if you haven't done so already.